Hello everyone. On Friday, premium for OTM weekly Sensex put options contract spiked even as the market recovered. The spike was abnormal, with premium shooting up 7 to 80 times across different strikes, causing losses to multiple traders. For instance, the premium on the 65,200 strike jumped from a low of 1.6 to a high of 105 rupees. A similar incident was seen on FinNifty options on Tuesday, where put premium surged dramatically on the expiry day, triggering stop losses of many traders and making strategies less profitable for some others. Traders losing money when market moves sharply is common, but what makes last week development unusual is that traders were wrong-footed in those pockets of the market where there should have been the least volatility. Through this explainer, we will try to make sense of what is happening out there in the derivative market. This is because on both days, prices of put option was rising when the market was going up. On Tuesday, the FinNifty was in an uptrend, and on Friday, the Sensex was recovering from the day low. When the market was rising, ideally the premium on the call option should be rising because of increased demand. Similarly, when the market is falling, the premium of put option should rise because of the strong demand. Now, let's first understand what are call and put options. So, call option allow the buyer to buy an asset at a predetermined price. The buyer can even choose not to buy, but if he decides to go for it, the seller of the option has to honor that contract. Let's take an example. Say I buy a Nifty call of 19,200 when the index is at 19,100. So once the Nifty goes past 19,200, I am making money on the rise of every point from there on. This is a typical example, and I'm not calculating the options premium. So it gives me the right to buy at 19,200 no matter where the index is at that point. If the Nifty is at say 19,500, I will make a clean profit of 300 points. So, what is a put option then? Well, it allows the holder of the option to sell an asset at a predetermined price. Say I buy a Nifty put of 19,100 when the index is at 19,200. Once the Nifty falls below 19,100, I will make money on every point of fall from there on. It gives me the right to sell at 19,100 no matter where the index is at that point. If the Nifty is at 18,700, I make a clean profit of 400 points. What's in it for the person who sell call option or put option? Well, the seller of the call option is betting that the market won't rise, which is why he is agreeing to sell you the asset even if the price goes up. Similarly, the seller of the put option is betting that the price won't fall, which is why he is agreeing to buy an asset off you even if the prices fall. Well, let's understand what is OTM contracts. So, options have varying strike prices with a gap of 50 to 100 points, depending on the index. Now, an option contract with a strike price close to the spot price is called ATM or at the money. For instance, if the Nifty is trading at 19,200, a strike price of 19,100 and 19,300 will be called as ATM, and 18,900 and 19,500 will be called as OTM strikes because it is away from the spot price. Okay, now let's understand why do traders buy OTM contracts. See, the premium on OTM contract is dirt cheap because the probability of those strike prices getting triggered is very low. For instance, if the Nifty is quoting at 19,200 on expiry day, a sudden 300 point rise or fall is highly unlikely. Majority of the buyers of OTM call options and put options are treating it as a lottery. Say the Nifty moves in either directions by even 150 point, the premiums on the 300 point OTM will rise many folds. Now, understand that why do traders sell OTM contracts if the premiums are low and the risk is high? So, take it this way. OTM sellers are betting that since the probability of occurrence is low, the risk in this strategy will be low. If they collect even small amount of premiums from a large number of option buyers, that works out to be a tidy sum. Well, is there any other reason why traders buy OTM contracts? Well, many traders buy OTM contracts as a hedge and to reduce their margin obligations to exchanges. Let's understand this with an example. So, you have sold a Nifty call option at 19,200. The risk for you is the index falling sharply below 19,200. Say you were to buy a Nifty put option of 18,900, then any fall below 18,900 will not hurt because you would stand to make money on the put options you have bought. From the stock exchange perspective, the risk for you then is only 300 points from 19,200 to 18,900. So the margin money payable to the exchange would be lower. Say if you only had to position in 19,200 options. Now, what happened on Tuesday and Friday last week? Let's understand this. To answer that, we need to understand what is happening in the derivative market right now. There is right now a weekly option contract expiring on every day of the week across the BSE and NSE together. This is drawing a lot of traders who are trying to make a quick buck by by taking positions just for the day. One theory is that a sharp up move in FinNifty on Tuesday and the recovery in Sensex would have caused losses to traders who had sold call options. The traders tried to offset their losses by building new positions near at the money options. Among the strategies would be to sell ATM put options or ATM straddles. Selling a put and a call option of the same strike price is called straddle. As a hedge against these positions, the traders would have bought OTM options. Why did that cause OTM put premiums to spike? Most likely, there would have been strong demand for OTM put all of a sudden. That would have caused the premiums to surge, in the process, triggering stop losses and forcing sellers of the OTM puts to cover their positions. Since OTM contracts are not as liquid as ATM contracts, the upswing would be sharper. So, who lost the money? Well, the writers of the OTM contracts looking for easy money would have lost heavily because they would not have been expecting those spikes. Also, the buyers of the OTM hedges would have ended up paying a much higher cost than usual, which would have made their overall strategy unprofitable. Look at this way. If you were looking to buy a hedge at rupees 2.5 and ended up paying for it rupees 50, it would be a dent to your profit. Will these development make traders wary of punting into these OTM options? Well, it depends. For a writer of OTM option, last Tuesday and Friday development have turned out to be a case of picking up pennies in front of a steamroller. Well, when the gains are small, but it appears almost risk free when they are actually not. But look at it from the perspective of buyers of OTM options. They would have made handsome profits in a matter of few seconds when the prices of those put options surged. So, what are the key takeaways from the massive surge in OTM options on expiry day last week? Well, number one, buying OTM hedges on expiry day may no longer be as effective a strategy as in past. Number two, stop losses will need to be devised more intelligently so they don't get triggered because of random spikes. And number three, selling unhedged OTM options is definitely not a risk free strategy anymore. Hope this will help you in a better understanding options trading and improve your trading style. Don't forget to share this video with like-minded people and do subscribe this channel for more such content. And I'll see you in the next video.